Welcome to PSG Asset Management with me, Joanne Baynham, independent moderator. Today I'm chatting to Lyle Sankar, head of fixed income at PSG Asset Management. Lyle, I'm going to dig a bit deeper. Talk to me more about your integrated approach to running money and how the team assists in generating these returns.
Sure. So, this PSG aim or PSG Asset Management way of managing money, this has been around for more than 20 years. So this is the same way we manage money in equities, we manage it in fixed income. So really the focus there is on a philosophy of risk first, so not losing clients' permanent capital or avoiding permanent capital loss, and then looking for mispriced quality. And if you think about the fixed income context, that really suits a fixed income investor. You're looking to safe place to put your money, and then risk-adjusted yields, yields that compensate for prevailing market risks. And I think with that one integrated process, we're able to deliver across asset classes.
Okay, so I'm picking up a lot of the market has a view, we have a view from what you're telling me. What do you think your edge is at PSG? What sets you apart? What makes you better than everybody else? In a nutshell, is it your behavioral aspects of why you run money? Is it your information ratios? Just in a nutshell, what is it that gives you the edge?
Yeah, I think it's a few things that we try to do on a day in and day out basis, and try to be repeatable and consistent. But for me, the key element that I would pick out is we're not going to sit here and say we can forecast short-term data perfectly. We actually spend very little time on that. We try to look longer term. The second part is, you touched on behavioral, and I think it's underweighted. It's actually a very key edge for us. And it's from junior analysts all the way to chief investment officers. You've got to have the willingness to approach risk, looking for the opportunity, but then also when the margin of safety isn't there, be able to walk away from opportunities. And for our team, we try to think about where things can go wrong and how we can protect capital, but then also focus equally on where things can go right and where the market's mispricing the opportunity. And if you do that repeatedly and consistently, I think you get 6 out of 10 right. And that's going to get the odds in your favor over time.
I think I've seen a stat that says if you're 51% right most of the time, you're going to be top quartile all the time. And let's face it, fund managers often make mistakes. So I think 6 out of 10 is an incredibly good hit ratio. Okay, and one of the things you and I talked about, like off camera, is this, you're very anti-corporate bonds at the moment. And you particularly didn't like the view of them having a high Sharpe ratio. Can you explain to us what you're talking about?
Yeah, so you pick very close in that description. I think when we're looking at corporate bonds, we want to buy them when the spreads are high. So you're going to get a yield above JIBAR or above cash rates. We want to buy them when we think the market's mispricing the risks of a corporate. Today, we see none of that. So we see very tight spreads because so much capital has moved to the income space. And if you think about it, if you're not going to buy government bonds and your SOEs are not doing really well, all that flow is moved into corporate bonds, and corporates in South Africa are not issuing bonds. So what it's meant is that compensation has come down. It's not risk adjusted in our minds. And that market's so small that I would classify it as fairly liquid. So what you get is, despite what happens in the market, it really trades. It doesn't trade sufficiently to reflect underlying risk. And so for us, what you get from it is if your portfolio is fixed, focused on corporate bonds, you're going to get almost the straight line performance, but it doesn't really reflect true reality of what the risks are. And from time to time, you see that come out. So we'll go back to 2020, and most will forget now that we actually had Land Bank and SOE that was in most fixed income portfolios defaulting. Subsequent to that, we saw very little remarks downwards. The pricing doesn't move out. And we're seeing some of those scenarios now. And it worries us a little bit that there's this big focus on Sharpe ratios, and we don't think Sharpe ratios equate to risk adjusted. We think it can be
because these things don't price.
Essentially,
is what you're telling me.
You're not buying an asset that's non-correlated to the market. It's just really it doesn't price. And I think most will forget in COVID these assets actually froze, and it was a liquidity constraint.
Very quickly, just to end off, you guys do something slightly unique in the marketplace, from what I can understand, where a lot of fixed income managers buy local property for additional yield. You do something slightly nuanced. Tell me about it.
Yeah, so you're talking about our flagship fixed income fund. That's the PSG Diversified Income Fund. It's really a portfolio that we think is in the sweet spot. So if you think about the needs of an income investor, they want capital preservation, we tick that box. We want to ensure we always tick that box. But then you want a very attractive income return that you can get from various sources, so well diversified. So when you're thinking about what that fund can do, is we uniquely in the space target an inflation plus benchmark, so CPI plus 1 after fees. So really, our key focus is to beat inflation, and in that we think you'll beat cash returns and you'll beat the money market space, and over time you're going to get a little bit of growth alongside that. So what we do that's unique in the space is obviously I think you have a good understanding of how we manage fixed income, how we actively manage across asset classes, using all asset classes, all curves, so inflation-linked bonds, NCDs, nominal bonds, really focusing on where we can get the best risk-adjusted returns for the funds. But then that's going to get us to our core fixed income portfolio, and this is a local fixed income portfolio. What we then do in addition is we use a small allocation to equities, property, preference shares from our globally integrated process. It's an edge that we think we have in the space. Typically, guys buy property, local property. It's correlated to government bonds. We think there's a better way to do it. Open the toolkit up and say, how can we get many different drivers of return and mitigators of risk as well. So it is an edge that we think we offer, and we've been doing it for about 8 to 9 years in the space. We've yet to see sort of a fund apply that strategy.
Lyle, I'm going to have to cut you there because we could talk all day. Thanks so much. Well
Thanks,
done.
Joanne.